Many high-income taxpayers find that they either can't deduct a traditional IRA contribution, or they are entirely shut out of making Roth IRA contributions. It may seem that they are stuck with making non-deductible traditional IRA contributions with all their attendant problems. But there is a strategy that these taxpayers can use to avoid this situation. I'm the Tax Geek, and here are Backdoor Roths, oversimplified. First, a bit of review. With a traditional IRA or other tax-deferred retirement account, contributions are deducted from taxable income when made, and distributions are taxable in full when they are withdrawn. With a Roth account, there is no tax deduction or income exclusion when contributions are made, but if qualified distributions are taken, the entire distribution, including any earnings on the account, is tax-free when withdrawn. Whether or not you can deduct a traditional IRA contribution depends on whether you or your spouse participates in a retirement plan and your adjusted gross income. The 2024 deductibility phase-out ranges are shown on the screen, and keep in mind, these ranges are adjusted every year for inflation. Roth IRAs have AGI limits on contributions, which apply regardless of whether the taxpayer or spouse participates in a retirement plan. The 2024 phase-out ranges for contributing to a Roth IRA are shown on the screen. If someone with an AGI higher than the deductibility phase-out range contributes to a traditional IRA, they can still make the contribution, they just can't deduct it. This has the effect of creating a basis in the IRA of non-deductible contributions that must be recovered bit by bit as distributions are made, assuming there are both deductible and non-deductible contributions in the arrangement. The other problem with having a basis in a traditional IRA is that even though non-deductible IRA contributions are reported to the IRS as they are made on Form 8606, the IRS won't remind you of that fact when you take a distribution, often many years after the contribution was made. In other words, the IRS knows, but they won't tell. And how likely are you to remember a non-deductible traditional IRA contribution many years later when you finally retire and start taking distributions? Unless you're an absolutely meticulous record keeper or have used the same tax professional since you made the contribution, the answer is, well, not very likely. Roth IRAs don't have this problem. Since all contributions are non-deductible, the contributions are recovered before the earnings. It's much easier to keep track of Roth contributions than traditional non-deductible contributions, since you don't have to remember which contributions you could deduct and which you couldn't. And for qualified distributions from your Roth IRA, it's totally unnecessary. But again, the problem is that the ability to make Roth contributions is limited by your adjusted gross income. The limits are higher than the deductibility limits for traditional IRAs, but they are there. But there is a way around all this. It's called a backdoor Roth. Here's how it works. Step 1. You make a non-deductible contribution to a traditional IRA. Step 2. You convert that traditional IRA to a Roth IRA. You now have a Roth IRA, even though it seemed you are not eligible for one. Normally, when you convert a traditional IRA to a Roth IRA, income tax must be paid on the amount converted. But since AGI limitations rendered the traditional contribution non-deductible, the IRA now has a basis equal to the contribution, and no tax is due on the conversion. You now have a Roth IRA with all its advantages. This works because A, there is no dollar limit on a Roth conversion, and B, there are no AGI limitations on a Roth conversion. Just keep in mind, if there are any earnings associated with the traditional IRA you converted, income tax will be levied on those earnings upon conversion. Let's see how this works. Artie is single, age 55, and he would like to contribute to an IRA in addition to the 401k plan he participates in at work. For 2024, his adjusted gross income is $184,000. He would like to put $8,000 into an IRA, consisting of the regular IRA limit of $7,000 plus his $1,000 catch-up contribution since he is over age 50. If he contributes the $8,000 into a traditional IRA, he can't take the IRA adjustment because his adjusted gross income is greater than $87,000. If he tries to put the money into a Roth IRA, he can't because his adjusted gross income is over $161,000. So to get the benefit of a Roth IRA, he makes a non-deductible contribution of $8,000 into a traditional IRA and then more or less immediately converts the traditional IRA into a Roth IRA. The result? A Roth IRA with a balance of $8,000. As streamlined as this seems to be, there can be some pitfalls. First, if your traditional IRAs contain a combination of deductible and non-deductible contributions, tax must be paid on the deductible contributions and their associated earnings when doing a Roth conversion. If this is the case, the best thing to do is convert all traditional IRAs into Roth IRAs all at once so the basis is recovered all at once. However, if you convert only a portion of the total amount of the IRAs, any basis has to be prorated and cannot be recovered all at once. For a clearer view of how this is done, check out my video on traditional IRA distributions by clicking in all the usual places. So how is a backdoor Roth reported on a tax return? All non-deductible IRA contributions, including Roth IRA contributions, are reported using Form 8606 non-deductible IRAs. The form is also used to report distributions associated with non-deductible contributions and Roth conversions. In this case, Artie enters his non-deductible traditional IRA contribution of $8,000 on line 1. For oversimplification's sake, we're going to assume that he has no other traditional IRAs containing either deductible or non-deductible contributions. Since he completed his Roth IRA conversion, he skips lines 4 through 7 and enters the amount he converted to his Roth IRA on line 8, which again is $8,000. This figure is also entered on line 16 on page 2 of the form. He didn't have the traditional IRA open long enough for it to generate any earnings, so the basis in the traditional IRA is still $8,000. This shows up on line 11 of Form 8606, and that amount is also entered on line 17. Subtracting line 17 from line 16 results in a taxable amount of 0, which is entered on line 18. At this point, the form is complete. On Artie's Form 1040, the $8,000 he converted from the traditional IRA to the Roth IRA shows up on line 4A as an IRA distribution, with a taxable amount of 0 on line 4B, plus the notation rollover on the dotted line. So this is a backdoor IRA in its simplest form. For more details on this subject, or Roth conversions in general, there are additional resources and information linked in the video description. Please like the video if you found it informative, and share it with anyone else who could find it useful. Subscribe to the channel for a direct link to other oversimplifications of our overcomplicated tax system. This video was inspired by this comment. If you'd like to see your suggestion turned into a video, please leave it, along with any other questions or comments, in the comment space below. Thanks for watching, and I'll be back soon with more of Your Taxes Oversimplified.